5 minutes. What if I tell you that is all you need to analyze any mutual fund and know whether it's right for your investment goals? And to do that, I'm sharing a framework that I've built called Flash. In it, F stands for fundamentals, L for long-term returns, A for approach and allocation, S for stress and stability, and H for how it fits your portfolio. This very powerful framework cuts through all the noise and helps you filter out the bad funds and also spotlight the good ones. It helps you analyze mutual funds in a flash. And in this first episode of the Flash series, I'm not just going to explain how it works, I'm going to apply it live by analyzing one mutual fund step by step right in front of you right now. And by the end of this video, you will have a tool that works for any mutual fund and any goal. If it makes investing simpler for you, just let me know in the comments and I'll continue decoding more mutual funds through this particular framework by putting the flash on it. Hello everyone, if you're new to my YouTube channel, I'm Uday Nathe and I've been licensed in Indian financial services since 2015, and so far I've helped over 1,500 families make better financial decisions. And here on my YouTube channel, I talk about all things money and personal development. So today, I'm analyzing the Parag Flexi Cap through the Flash framework. Let's kick it off with the F, which is fundamentals. First up, you've got to check the very basics, the credibility and the reputation of the fund house in which you're investing money. So for the Parag Flexi Cap, we're looking at the Parag AMC. And we want to check if they're hitting all the right quality marks. Because let's be honest, right? You don't want to give your money to a fund house if they seem a little suspect. Then a part of fundamentals is also the fund manager. Now think of fund managers as the captain of your favorite cricket team. They're taking all the right calls, right? Who to pick, what strategy to have. So you need a seasoned captain or a fund manager. Someone who's been with the fund house for a good while, brings a lot of experience to the table. Now, if the fund manager is new to that particular scheme, it's not necessarily bad, but just because there are so many mutual funds out there, it just might make more sense potentially to again go with a fund house and a fund specifically that has an experienced fund manager. And finally, within fundamentals is the fund category. Now, in the fund name, you will notice the fund category is explicitly mentioned. Like for example, in the Parag Flexi Cap, it is mentioned that it's a Flexi Cap fund. What that essentially means is that fund managers who are managing this fund can have any number of stocks in any number of the categories that are there: large cap, mid cap and small cap. There is no rule restriction where they have to only invest 20% in one or can't invest in one. There is nothing like that. There's complete fluidity. Now, understanding this categorization is very important because it directly dictates whether you should invest in it. Like for example, with a Flexi Cap fund, it is an entirely equity fund, right? It's investing all of its money in stocks. So because of that, having a time horizon of at least 6 years is a good idea. But let's say it's a mid cap fund or a small cap fund, having an even long-term time horizon of 7 to 8 years could be a better idea, because anything lower than that, it's not like you lose money always, but just the chances of you getting negative returns or lower returns go up as the time horizon goes down with equity funds. If you want to apply what I share here on YouTube to your own life and investing, check out my program, The Complete Guide to Mutual Fund Investing. It has all my years of experience of being licensed in Indian financial services since 2015. In it, I've covered topics like how you can select mutual funds to invest in, how to build your mutual fund portfolio, a much deeper dive than this particular video, what is an SWP and how to plan for your various goals, among other topics as well. The guide also has Excel tools like this one, where you just enter the goal that you have, the money that you require for it, and it automatically tells you, factoring in inflation, how much you need to invest per month from now onwards and which mutual funds to go for to save for that goal. Once you sign up for the guide, you'll also be part of our monthly live Q&A sessions where I answer all your doubts. To check out the program, go to the first link in the description and the pinned comment. Now, I do understand that all of these terms may seem like a lot. So here's the very first thing that you want to do. When you're analyzing a mutual fund, all you have to do to begin with is to search it on Google, right? So there you go, search it on Google. And the one website that you want to go to first is a website called valueresearchonline.com. It might show up as the first result or the second or third result, but essentially you want to go to Value Research Online and check out the fund there. Now there are other websites too, but I just find the interface of Value Research the best amongst the mutual fund data websites. So once I go to value research, you will notice that I see the fund name right away. A lot of things are happening here. It's called a direct plan and all of that. You can see a lot of graphs. Just ignore all of that. The first thing that you want to check out is this first categorization, which is equity, which essentially means it is investing in stocks. Now, within the world of stock investing, it is a flexi cap fund. Like I said, there's flexibility to the fund manager given as to where they can invest. So again, right, if you're investing for a goal that is 3 years away, you don't want to invest in the flexi cap fund. I had made a video, in fact, on the kind of category you should select when you're choosing which goal to invest for. So you'll find that link to that video in the description, so check it out. But for long-term goals, let's say 6-year plus goals, a flexi cap fund could be a good idea. So that is what you first want to know. And after that comes the reputation and credibility of the fund house. Now, in just how much information is available out there, it becomes very tricky to actually know which are the good, reputable fund houses if they're facing any issues. Because the issues, when they come out, they might make a lot of headlines, if at all they do. But at times they go under the radar. So it's important to do your own due diligence. And for that, we're going to take the use of AI. So I'm right now on perplexity.ai. If you haven't used it, would definitely recommend you using it for a bunch of other things, not just doing your investment research and just getting better at investing. Perplexity has essentially replaced Google for me. All searches I do are now through Perplexity. I have the paid app here, but what I'm doing right now is available to you for free as well. So what you want to do on Perplexity is that you want to tell Perplexity that you are my investment research personal assistant and due diligence officer, and I want you to create a report on this AMC and this particular fund. We'll enter the fund name, and based on best practices of AI prompting, we want the return format to be in a particular way. I have described everything that we want to know from our personal assistant. So there you go, right? So we have all of this information. I'll just enter the mutual fund name scheme. So it's the Parag Parikh Flexi Cap, right? So I'll just enter the name. So once I've entered this, what I want to first select is, and at times the auto toggle might be selected, you want to do a pro search. Ideally, you can also do a deep research, but deep research on the free accounts, I think there are 3 or 4 deep researches per day available. I think it's the same for pro. So reserve your deep searches and pros just for, analyzing different investments, different mutual funds when you're first investing in them. So let's do a pro search. You can also be a deep research, but let's do pro search. So that just in a matter of a few seconds, at times a minute, you get a very detailed summary and we'll exactly know what it is. So here we go, right? Perplexity has gone through 50 sources and has generated this report for us. So a very quick snapshot analysis. This is what I'd asked it to provide. So there you go, right? AMC credibility. It's a reputed AMC. AMC stands for Asset Management Company. It has an AUM of 88,000 crores, right? As of February 2025. The main fund manager is Rajiv Thakkar. He's been with Parag Parikh since 2001. The fund was only launched in 2013, but before that, Parag Parikh did a lot of boutique investment advice through various other means apart from a mutual fund. And there you go, right? Investing style. We'll get into this a little later, but it also shares that. What is important to know right now is that the fund employs a value-oriented, bottom-up selection strategy with flexibility across market caps and sectors. That's correct, right? What we did not know here was, before that it was a flexi cap, was that it employed the value style of investing. It also says it also includes international equity exposure up to 35%. So within the Indian framework, the way the laws work, any mutual fund can potentially invest up to 35% of their total money in international stocks. And Parag Parikh utilizes that. It's not 35% right now, it's about 30%. We'll see that as we go along, right? Here's the more detailed analysis of the Parag Parikh Flexi Cap and the Parag Parikh AMC. As you can see the entire name as well, Parag Parikh Financial Advisory Services, and we can keep scrolling down, right? So the fund manager, this is very important, right? We want a fund manager who's been around with the fund house for a while. Rajiv Thakkar has been there for more than 2 decades. Fantastic. He's been basically involved in the scheme since the very start, which is fantastic. He's also widely reputed. He's widely regarded as a disciplined value investor who prioritizes long-term creation while mitigating risks during market downturns, which is fantastic. Then when it comes to investing style, right now there's 77% equity, about 22% cash. So 22% of the money that the fund has currently is not invested. They're keeping it as cash. In the future, when they see opportunities, they will deploy that cash. You can see different sector breakdowns. Within the equity style, you will see 61% in large cap, and mid cap and small cap have other smaller allocations. We'll get to that later when we get to the A of the Flash framework that we have built. But overall, the conclusion is that Parikh is a well-managed mutual fund backed by a credible AMC. Rajiv Thakkar brings extensive experience. So both those boxes get ticked off. Now, there could be funds where the AMC has been around only for, let's say, 2 years. Now, that doesn't make it a bad AMC because all AMC started somewhere, right? But just that there are so many options available. Why do you want to go with someone who's relatively new? Why not just go with someone who stood the test of time through different market conditions? The only exception that I would say you can potentially make while selecting a new fund or a new AMC is if it's offering index funds and if the fund manager at the back end has extensive experience of handling index funds. But even then, if only choose that if that's the only option available. Otherwise, there are always better experienced options in the market. So in terms of the fundamentals, it's either a yes or a no. And if we have long-term goals, then considering this fund is a yes, right? Because it has a credible manager, it has a credible reputation as a fund house. Now let's dive into the L of our Flash framework, which is long-term returns. And here I'm specifically looking at rolling returns, and I will share why. Most people only look at, say, 1-year returns or 3-year annual returns. And in such cases, when you're looking at annual returns or CAGR, you're essentially looking at only two numbers, right? The time when you first invested money and the last date on which you're checking the returns. The problem with that is what happens in the middle is not at all recorded. But, the fund could have had 2 great years, but 2 bad years. And the average return is still high because the 2 great years was so good. That's great on paper, but when you're actually invested in the fund, you feel anxious, right? Just the last 5 months, they were hard for investors to see the value of their portfolio drop. But with rolling returns, you get a better idea of the consistency of a fund because it looks at every single day within the time span that you're looking at and how the fund has moved over that entire period. So rolling returns gives us a true picture of a fund's consistency. Now here I will not just see rolling returns, I will also compare it to the benchmark of that particular mutual fund. So let's say in the case of a Flexi cap fund, usually the benchmark we look at is the Nifty 500, which is India's 500 largest stocks, which includes the 100 biggest, which are the large cap stocks, then 150 mid cap stocks and 250 small cap stocks. So here I am checking the rolling returns of the Parag Flexi cap against the Nifty 500 and also the category average of all other Flexi cap funds in India. So this data since 2013, 5-year rolling return for a lump sum investment, and you can potentially see, right, almost every single time except for this one very minor window potentially here, the Parag Flexi Cap has beaten both the Nifty 500 and the Flexi Cap category average, right, which is fantastic, because that's what we want. We want a mutual fund that has done well compared to its peers at every single time. Even during the COVID crash, if I just hover my mouse, you will notice that the Parag Flexi Cap was plus 3.48%, whereas equity Flexi Cap as a category and Nifty 500 were negative, even though marginally. Then let's get a summary of these returns as well. The Parag Flexi Cap, the median 5-year rolling returns are 17.8%. Again, hands and shoulders above the two peers that we are comparing it against. How many times has it had over 20% annual returns? 34% of the time. Again, a big winner compared to the two benchmarks or two categories that we're comparing it against. At the same time, if you look at risk, which is kind of measured through standard deviation, it's 4.82, again very similar to the other two. We'll get into risk and stress later on when we tackle S. But so far, right, it has never given negative returns. It has given a higher overall return. So that's fantastic. So even that box is ticked. So far, so good with the Parag Flexi Cap. Next up is A for approach and allocation. Approach means the investing style that the fund manager uses. So earlier, while we were going through Perplexity's report that had been generated for us, we noticed that the Parag Flexi Cap, for example, follows the value style of investing. Now, if you enter a different fund name, you'll come across various investing styles. Mainly it will be growth, momentum, value, quality. And this matters because when you're building your portfolio, you want a mix of different funds that covers the three main investing styles, momentum, growth and value, and also includes various size stocks, large cap, mid cap and small cap. So if you're investing in different funds, you don't want to have, let's say in a 5 or 6 fund portfolio, 4 funds only investing in value style of investing. Because what that does is at the end of the day, you're investing more or less in the same places. And if that style is not working at a point in time, then a large part of your portfolio is also not working. So you want a nice diverse mix. In terms of allocation, it's again really about where the fund is actually investing. With the Flexi Cap fund, like I told you, the fund manager can invest any amount, any proportion across large, mid and small cap stocks. But within that, it's important to know how much money Parag Flexi Cap is investing in large cap, mid cap and small cap. Because for all you know, 80% of the money could be in small cap stocks, right? And in that case, you want to again have a defined proportion in your portfolio. So I'm on ET Money, which gives you a very good analysis of essentially the asset allocation or the portfolio allocation in a particular mutual fund. So as you can see here, equity 77%. We got a snapshot of this when we were going through Perplexity earlier. That's why I love to have that as the fundamental entry into mutual fund research, because it gives you a good bird's eye view. And now we are drilling it down into the specifics. So 77% is in equity, 21% in debt, which is essentially the cash they're holding. Then across the entire portfolio, right, almost 75% is in large caps. And the rest is in different categories, mid and small. So it's predominantly a large cap fund, which is what I've noticed is the case with most flexi cap funds. Not all, but most flexi cap funds, that they're large cap heavy. Now, Perplexity also told us that this invests in international stocks. So if you look at the detailed portfolio of the Parag Flexi Cap, you would notice, right? You would notice if we go down, this is the complete stock holding. So what this essentially means is that if Parag Flexi Cap has 100 rupees, 8.43 rupees is going into HDFC Bank, 7% into Bajaj Holding and Investments, and so on. But here you will see, right? Here you will see some international stocks popping up. Alphabet, which is Google, 3.19% of the money goes there. Then you can see also 2 other international stocks here, Microsoft and Amazon, both at about 2.89%. So by again investing in this fund, you're getting that international flavor. So if you want to invest in a similar large cap heavy mutual fund, then investing in one more fund that has similar principles, like for example, the DSP Value Fund, which is also large cap heavy, which also has international stocks, may not be a good idea, because at the end of the day, you end up investing in the same places even though you're holding 2 different mutual funds. So when you're building a mutual fund portfolio, this aspect becomes very important, because you want funds that complement each other and not just that are replicating each other. Now let's move on to the S in our FLASH framework, which stands for stress and stability. This section is all about understanding how a fund behaves, not just when everything is going great, but when markets are having a rough time, or they're uncertain, or they're just going down for months together. And to measure that, one of the most useful tools that we have is something called as the capture ratio. Now don't worry, I'll break this down very simply for you. There are 2 parts here. First is an up market capture ratio, and the second is the down market capture ratio. The up market capture ratio tells us how much of the market's positive returns has the fund been able to capture when the markets are rising. So if the Nifty goes up by 10% and the fund has gone up by 11%, that means the fund has an up market capture ratio of 110. The down market capture ratio tells us how much the fund fell when the market was anyway falling. So similarly, if the Nifty fell by 10% and a fund fell by 8%, then the down market capture ratio of that fund is 80%, which means it cushioned the fall much better. Now, a fund that consistently has high up market capture ratios and low down market capture ratios is a rare gem. And I know that that math may have seemed complex, or you may be wondering, where am I going to get all this data from? Luckily, Advisor Khoj has a tool that is inbuilt, where all you have to do is select the equity flexi cap category. The link to where you can find this tool is again in the description. You can get it for free. You select the flexi cap category and you enter the different flexi cap funds that you want to compare. You select the time period. We look at different time periods. It's 3 years right now, and we press submit. Now the moment that happens, it will auto calculate all the capture ratios for you. So here's the thing, right? Up market capture ratio, if you think about it, is very low for the Parag Flexi Cap, right? 89 only, whereas Quant Flexi Cap, HDFC and JM have a very high up market capture ratio. If we compare it to the down market capture ratio as well, you will see that the Parag Flexi Cap has the lowest down market capture ratio, which is fantastic, of 51%. What this essentially means is that if the market went down by 20%, this fund has only potentially gone down by 10%. Crazy, right? Now, one very important aspect that again captures both these numbers is the total capture ratio. So it's up market capture ratio divided by down market capture ratio. This number needs to be as high as possible for capture ratios to work in the fund's favor. If you notice, HDFC Flexi Cap has the highest capture ratio here of 1.75, while Parikh Flexi Cap comes in second at 1.72. A very marginal difference, but there's still a difference. Does that mean the Parikh Flexi Cap is a bad fund? Not at all, right? Because the down market capture ratio, I think, is very important. In fact, I rate it much higher than the up market capture ratio or the total capture ratio. Especially the total capture ratio is somewhat similar to other peers. That's because when the market is going down, people get fearful, people get anxious. So if your fund naturally falls lower, you are in a much better position and you're likely to stay invested. And that is the key, right? Just staying invested during all kinds of market conditions. That's how you build big wealth over 10, 15, 20 and 25 years. We look at a 5-year capture ratio as well for all these funds. And here you will again notice that the Parag Flexi Cap this time has a down market capture ratio, again a very low one of 55. The up market is around 93. In terms of total capture ratio, now you can see the HDFC one has dropped, but not by a lot. It's still a good number. Anything above 1 is great. The higher you are, the better. Parikh still holding strong at 1.7, whereas Quant is now much closer at 1.54. But there you have it, right? No red flags so far. Rolling returns were getting a big green flag. So do the capture ratio. So it's handling the stressful times well. We saw the standard deviation as well. If I can just quickly go back to that screen and show it to you. Again, the standard deviation is not very different, right, than the benchmark and the category average. So it's getting a tick mark there as well. Now that we have looked at everything so far, right, the fund's fundamentals, its historical returns, how consistently it performs, then how it has done when the market is under pressure, it's time to ask a very, very practical question, which brings us to the final part of our flash framework, H, how it fits. Because this isn't just about whether a fund is good or not. It's about whether it fits in your portfolio and whether it adds something unique to your portfolio. Now, the Parag Flexi Cap, despite being labeled a Flexi Cap, like we saw, is actually quite a large cap heavy fund in terms of where it invests. It also follows the value style of investing and gives you a bit of international exposure, which I think warrants for it to be a part of most portfolios, because all of these things are a rare combination amongst Indian mutual funds. So it's perfect in a way if you're looking to add a value-oriented, globally diversified and large cap heavy fund to your portfolio. But if your portfolio already has a fund, or let's say a combination of 2 funds that covers all of these things, then it might not make too much sense to add it. So clearly, as per the flash framework, the Parag Flexi Cap gets a thumbs up. Now, having said all of that, despite the Parag Flexi Cap actually passing through our flash framework, it's very important to remember that at the end of the day, any mutual fund, whether it has passed through this framework or whether it hasn't, it is investing in stocks, right? An equity mutual fund. So it is very possible that if the market is not doing well, your fund would not do well, or at times the market may be doing well, but the kind of investing style that your fund employs is not in sort of season, right? Some other investing style is doing well at that time. So despite this analysis, and you can, there's a way to also do a deeper analysis, despite all of that, there is a chance that the fund that you have selected does not perform well, but that is where holding that investment for a longer period of time, unless, fundamentally things change at the fund level, at the AMC level, and I'll make a video soon as well on when to sell a mutual fund, when to exit a bad performing mutual fund. So the most fundamental thought here is that the longer you hold an investment, the higher are your chances of getting decent returns from it. If you found this video helpful and felt that the flash framework made mutual fund analysis simpler for you, let me know in the comments. I would love to review more mutual funds using the same approach. So if there's a specific mutual fund you want me to cover, then just drop the name in the comments and I'll break it down for you in a flash. And I'll see you in the next one.